Imagine a bank that takes your money, locks it in a vault for 30 years, and tells you that if you try to take it out early, they will fine you. Then they tell you they can change the tax rate on that money at any time before you get it back. You would never sign up for that bank, but millions of Americans do it every paycheck. It is called a 401k. And today I'm going to show you why the tax advantage is actually a trap. Before we open the case file on the greatest liquidity heist in history, please take a moment to subscribe to the channel and like this video if you want to support more forensic financial analysis like this. There is a pile of money sitting in America worth $40 trillion. It is the largest accumulation of liquid capital in human history. You call it your nest egg. The US government calls it a target. As the national debt spirals out of control, the politicians are looking at your 401k not as private property, but as a solution to their spending problem. And history shows exactly how they plan to take it. Most people believe the retirement account is a personal vault. They see the balance on the screen and they think that money is theirs. They think it is walled off from the chaos of the federal budget. But forensic history tells a different story. You do not own the money in your 401k. You own a claim on a future government promise, and that promise is mathematically impossible to keep without a massive transfer of wealth from savers to the state. We are witnessing the early stages of a phenomenon known as financial repression. This is a term coined by economists to describe how bankrupt governments liquidate their debts without officially defaulting. They do not steal your money in the middle of the night. That would cause a revolution. Instead, they steal it slowly through inflation and regulation. And the 401k is the perfect mechanism for this theft. To understand why, we have to look at the ledger of the United States Treasury. The US government is running massive deficits. They need to sell trillions of dollars of debt every year just to keep the lights on. For decades, they sold this debt to China, to Japan, and to the Federal Reserve. But those buyers are leaving the market. China is selling. Japan is selling. And the Federal Reserve is trying to shrink its balance sheet to fight inflation. So who's left to buy the debt? Who has enough money to fund the US government? You do. The $40 trillion in US retirement accounts is the only pool of capital large enough to absorb the new supply of treasuries. But you are not buying these bonds voluntarily because the yield is lower than inflation. If inflation is 4% and the bond pays 4%, you are making zero real return. No rational investor would make that trade. So they have to force you. This is where the trap closes. The government does not need to seize your account to use it. They just need to pass a regulation. It is called Macro-Prudential Regulation. It sounds boring, but it is dangerous. The government simply mandates that all tax-advantaged retirement accounts must hold a certain percentage of their assets in safe government bonds. They will sell it to you as a safety measure. They will say they are protecting you from stock market volatility. But in reality, they are forcing you to buy the debt that no one else wants. They are turning your nest egg into a captive buyer for their deficit. This is not a conspiracy theory. It is a historical pattern. We have to open the case file on Argentina in 2008. Shutterstock. Argentina had a private pension system called the AFJP. It was very similar to the US 401k. Workers contributed a portion of their salary into private accounts managed by investment firms. It was popular and it was successful. But by 2001, the Argentine government was drowning in debt. They needed cash. First, they used a soft touch. They strongly encouraged the pension funds to buy government bonds. They offered tax incentives. They pressured the fund managers. The funds complied. They filled the workers' portfolios with government debt. But it was not enough. The debt kept growing. In 2008, the global financial crisis hit. President Cristina Fernández de Kirchner went on television and announced a bold new plan to protect the nation's retirees. She claimed that the private stock market was too risky. She said the greedy bankers were mismanaging the people's money. So she signed a decree to nationalize the private pension system. Overnight, $30 billion of private savings became government property. The individual accounts were wiped out and replaced with a generic government promise to pay a pension in the future. The people who had saved for decades woke up to find their nest egg was gone. It had been absorbed into the general budget to pay for current political spending. It was the greatest theft in modern financial history. And it was all done legally. It was done for the public good. But Argentina is often dismissed as a chaotic outlier. People say that could never happen in a Western democracy or a member of the European Union. So let us open the case file on Hungary in 2010. Hungary was a member of the EU and NATO. It had a sophisticated private pension system just like the US. But in 2010, the Hungarian government faced a budget crisis. They needed to lower their deficit to meet European Union targets. Prime Minister Viktor Orbán did not want to cut spending. So he looked at the private pension funds. He did not send the army to seize the banks. He used a much more clever mechanism. He gave the people a choice. The government issued an ultimatum to all citizens. You can keep your private pension savings if you want. But if you do, you will lose your right to the state pension entirely. Think about the leverage of that threat. You have paid taxes your whole life for a state pension. Now they are telling you that unless you hand over your private savings to the government, you forfeit 70% of your future income. It was a mafia offer, an offer you could not refuse. Predictably, 97% of the population surrendered. They signed their private savings over to the state. The government took possession of $12 billion in assets. They used that money to pay down the national debt and balance the budget for a single year. And once the money was gone, it was gone. The private accounts were deleted, the money was spent, and the people were left with nothing but a promise. Poland did almost the exact same thing in 2014, seizing half of the assets in private pension funds to lower their public debt numbers. This is the playbook. When a sovereign nation gets into a debt trap, private capital is not safe. It is seen as a national resource. But the most dangerous argument I hear is that it cannot happen in America because of the Constitution. People believe that property rights here are absolute. This brings us to the most uncomfortable case file of all. The United States in 1933. We tend to forget our own history. But in 1933, President Franklin D. Roosevelt faced a banking crisis. The government was running out of gold reserves because citizens were losing faith in the paper dollar and trading it for gold coins. The government needed that gold to recapitalize the system. So Roosevelt signed Executive Order 6102. It made it a criminal offense punishable by 10 years in prison for any US citizen to own monetary gold. The government ordered everyone to turn in their gold coins and bullion to the Federal Reserve. In exchange, they were given paper dollars at the official rate of $20.67 an ounce. Millions of Americans complied. They handed over their real wealth for paper wealth. Then once the government had all the gold, Roosevelt revalued the gold price to $35 an ounce. Instantly, he devalued the paper dollars in everyone's pocket by 40%. It was a massive transfer of wealth from the citizenry to the state. The lesson from 1933 is clear. When the system faces an existential crisis, the rules of property ownership change. The government will change the laws to ensure its own survival. Now look at the United States in 2025. Do we see the same signals? We see a government with an unpayable debt load. We see a desperate need for liquidity. And we see the legislative framework being built. But in the US, they might not even need a new law to trap you. The trap is already built into the product itself. It is called the target date fund. If you have a 401k, chances are your money is in a target date fund. This is the default option for tens of millions of Americans. You pick your retirement year, say 2050, and the fund manages the asset allocation for you. The design of these funds is to automatically shift from stocks to bonds as you get older. This means that every single day, millions of Americans are automatically selling corporate assets and buying government debt. They are doing this regardless of the price and regardless of the yield. If the US government bond market crashes because of a debt crisis, the target date funds will not sell. In fact, the algorithm forces them to buy more to maintain their target allocation. You are already a captive buyer, you just do not know it because the algorithm is doing the buying for you. But the government wants to tighten the screws even further. There is a bill called the Retirement Savings for Americans Act. It proposes a government match for retirement savings similar to the federal thrift savings plan. On the surface, it looks like a helping hand, but forensically, it is a bridge. It creates a direct link between private savings and the Treasury. It normalizes the idea that the government should have a hand in your retirement planning. And then there is the G Fund within the federal employee system. The G Fund is a special government bond fund that never loses value. It is the only asset in the world that guarantees a return with zero risk. Why does the government offer this? Because it keeps the federal employees' money inside the government. The proposal to create a similar structure for the private sector is not a gift. It is a corral. It is a way to herd $40 trillion into a pen where it can be sheared. But the 401k trap is not just about government bonds. It is about taxes. The entire sales pitch of the 401k is that you save on taxes today. You defer the tax until you retire. But think about the math of that deal. You are betting that tax rates in the future will be lower than they are today. Look at the national debt. Look at the unfunded liabilities for Social Security and Medicare. Do you really think taxes are going to go down in 20 years? The mathematical probability is that taxes will double. So you are taking a tax deduction today at 20% to pay a tax tomorrow at 40 or 50%. You are partnering with a business partner who is $60 trillion in debt, and you are giving them the legal right to determine your profit split 30 years from now. That is not an investment strategy. That is financial suicide. And the worst part is the lockup. If you see the crisis coming and you want to take your money out, the government hits you with a 10% penalty plus income tax. They have built a wall around your money. So how do we pivot? How do we escape the 401k hostage situation? The first step is to recognize that liquidity is worth more than a tax break. In a sovereign debt crisis, the most valuable asset is control. You need to be able to move your money instantly. You need to be able to sell paper assets and buy real assets. If your money is locked in a 401k, you have zero agility. You are a sitting duck for the next regulation. The strategic move is to get off zero. If you have a 401k from an old employer, you can roll it over into a self-directed IRA. Most people do not know this exists. A self-directed IRA allows you to take your retirement money out of the stock market casino and buy real assets. You can buy gold, you can buy land, you can buy private equity. When you buy physical gold in a self-directed IRA and store it in a vault, you have removed that capital from the banking system. You have removed it from the Treasury bond trap. But you have to be careful. You need to understand the difference between a custodian and an administrator. Many companies claim to offer self-directed accounts, but they limit you to a menu of assets they approve. True freedom comes from what is called checkbook control. This is where your IRA owns a special limited liability company, or LLC. You are the manager of that LLC. This means you literally have the checkbook in your hand. If you find a piece of farmland you want to buy to protect your wealth, you can write a check from the LLC and buy it instantly. You do not need to ask a bank for permission. You do not need to wait for a government administrator to approve the transaction. This structure breaks the chain of custody. It puts a legal entity between you and the government mandate. It converts your retirement from a passive pile of paper into an active sovereign fund. But for those who are currently employed and cannot move their money, there is a harder calculation to make. It is called the rug pull calculation. You have to ask yourself a question. Is it better to pay the penalty and the tax now to get my money out, or is it better to keep it in and risk losing half of its purchasing power to financial repression? Let us do the math on a $100,000 account. Option A is you leave it in. Over the next 10 years, inflation runs at 7%, but your bond-heavy portfolio only yields 3%. You are losing 4% of your purchasing power every year. This is the frog in the boiling water scenario. You do not feel the loss immediately because the number on the screen stays the same or goes up slightly. But in 10 years, your $100,000 might technically be $130,000. But because bread costs $10 and gas costs $8, your real purchasing power has dropped to roughly $65,000. You lost nearly half your wealth by staying safe. You paid an invisible inflation tax that was far higher than any penalty. Option B is you take it out today. You execute the jailbreak. You pay the 10% penalty. You pay the 20% income tax. You take a 30% haircut right now. You are left with $70,000. This hurts. It feels like a loss. But you take that $70,000 and you buy gold or Bitcoin or productive land, assets that hedge against inflation, assets that have no counterparty risk. If gold matches the real inflation rate over the next decade, your $70,000 preserves its power. And critically, it is yours. It is liquid. It is not subject to a new law passed at midnight on a Friday. It is not subject to a capital control decree. History shows that in times of crisis, the penalty for exit is the price of freedom. In Argentina, the people who took the hit and moved their money offshore or into physical assets survived. The people who stayed in the system to save on taxes lost everything. The 401k was designed in 1978. It was designed for a world of low debt and a stable dollar. It was designed for a world where interest rates were high and bonds paid a real return. That world is gone. We are living in a world of fiscal dominance. A world where the government must inflate away its debt to survive. A world where every pool of private capital is being eyed as a source of liquidity. The government has a $40 trillion hole in its budget. You have a $40 trillion pile of savings. You do not need to be a forensic historian to see what happens next. The math makes the outcome inevitable. The door to the vault is still unlocked. You can still move your money. You can still take possession of your future. But the regulators are writing the new rules right now. They are testing the fences. They are floating the trial balloons. Will you leave the door open? Or will you wait until you hear the lock click shut?